Chetan Ahya, Managing Director and Chief Asia Economist at Morgan Stanley, Johnson right now to talk to us. Chetan, great having you as always. Thanks for taking the time out, but it's been a while. So thank you so much for joining in today.
My pleasure to be on your show.
Thank you so much. Chetan, can't not start off with a very small micro because that's the big talking point in India currently. We'll expand the conversation to the correlation with Asia, etc. as well. But this incessant, very swift pressure on the Indian currency at a point of time when not all currencies have maybe done the same, maybe makes the policy more of a currency policy than an interest rate policy. But how do you think about all of these factors in India currently?
Look, I think the drivers to the currency weakness are twofold. Number one is that domestic growth trend. When you think about the corporate revenue growth, corporate earnings growth have been actually slowing, and that has held back the foreign investors. That always tends to be an influential factor as far as the rupee is concerned. And the other issue is the long pending stress on the trade front. The trade deal is still not done. And the investors I speak to are effectively saying that, look, we will look at the currency opportunity only once we see the trade deal actually in the bag. So there is very little confidence foreign investors have right now on that trade deal. So those are the two factors that is holding back the currency. However, if you sort of look at the outlook, our macro strategy team is expecting modest appreciation in the rupee. And that's because they are expecting in the first half of 2026, the dollar to weaken by about 4-5%. And so that's kind of, I think, the bigger focus that is going to emerge when you get into 2026.
And Chetan, does that tie in broadly with what will happen to rest of EM as well? Because I heard you say, or Asia, let's stick to Asia, right? Do you believe that a general dollar weakness would effectively mean strengthening of most counter-Asian currencies, and therefore India will be a part of a cohort that does this? Because quite frankly, unless I'm very wrong, Chetan, while the yuan and INR seem to be tied at the hip, if you will, for a better part of 2025, November kind of showed a big difference out there too.
Yeah, so we are expecting a modest appreciation across the board in the region. We are expecting the DM currencies to appreciate more than the EM currencies, particularly those in Asia. Remember that Asian interest rates are in general lower than the US interest rates. So Asian currencies will appreciate, but only modestly, and India is going to see some appreciation as a part of this group within the region.
Chetan, good morning. Hiral on this side. Now, if you have to tie this up to India's story, you've consistently had a bullish view when it comes to India's growth trajectory. You've spoken about domestic resilience, rising global importance as well. But from here on, what are the key risks one should be watching out for? Because the major overhang right now is tariffs. Apart from that, what would you watch out for?
Well, I think the story for investors has been sort of not so great because of the earnings and revenue growth that I mentioned earlier. And the reason for that has been weaker domestic consumption. We would expect that capex should also be strong, but capex cannot be strong if you have weaker consumption, and in the backdrop we have this concerns on exports front as well. So consumption and exports are the two top line drivers for the corporate sector. If these two line items pick up, then you will see over period private capex picking up as well. So I think from risk perspective, I would still list these two drivers if they don't turn around, which we are expecting to see a turnaround in both those factors. But if it doesn't materialize, that will be the risk to India outlook.
And are you expecting any significant tightening when it comes to central government capex in the second half of this year and going ahead? Because that's going to be key to understand what the private capex will look like as well.
Well, I think government capex is going to slow in terms of year-on-year growth rates because so far it has been really strong. But I think the driver to private capex is not just the government capex holding up, but the bigger factor is, whether all the easing measures which the government as well as the central bank have taken are going to transmit into that private consumption pickup. So we've seen four important set of policy actions. We've seen the government cut first household income tax cuts, or rather did the income tax cuts. Then we had GST cuts. So that's on the fiscal side. And on the monetary policy side, both interest rates and the regulatory easing for banks and non-banks, we think are the four important sets of actions that the government has taken in conjunction with RBI. And those are pretty powerful ones. And we are expecting that this will drive consumption from here on. And it's not just a forecast anymore. We do have high frequency data points saying that things have already turned quite nicely. If you look at the auto sales, initially people thought that this is a bump because of GST cuts, but also because of the festival season. But it has continued to maintain reasonable growth even after the festival season is well and over. So we think that, yeah, I think this consumption story is going to turn around and help the overall domestic demand. And then the exports part, that's another important driver that we think will turn around the top line for the corporate sector. Which is essentially the point that we are making that non-tech exports will also recover in 2026. Because so far what we've seen is that within the region, tech exports have done very well. So headline exports numbers for everybody in the region is looking well, except for India, because India doesn't really have much of tech exports on the good side. But this non-tech exports recovery is going to come through because we're expecting the US domestic demand to improve, particularly US non-tech capex. And at the same time, we have now deals done with most of the economies in the region, and in fact, globally. We do expect that India's deal with the US will also be done sometime latest by the first quarter. So that will help that non-tech exports recovery, and that will in turn also help India's corporate sector top line.
Chetan, just trying to understand the, how do I say, your assessment of FDI/FII, because I heard you say in your opening answer that until the trade deal is done and dusted, there won't be a return of FI capital. But Indian growth rates are looking okay. In your answer right now, I heard you say that this will drive growth. Will growth by itself not be a sufficient condition? Is the trade deal the inevitable important aspect between for foreign investors to come back?
No, not necessarily. I didn't mean to say that. I meant to say that that is one of the factors that the traders or the investors in the FX market are looking at very closely, the trade deal part of it. The FI equity investors are definitely going to look at growth more than the trade deal by itself. Trade deal is sort of more important for the sentiment of for the FX story, and maybe even the Indian corporate sector is their sentiment when they are taking the decision on FX is influenced by the trade deal. But for the FI equity investors, the bigger story will be what happens to consumption and its impact on domestic corporate revenues as well as profits. And we do think that, for India's macro outlook or corporate revenue growth and earnings growth, that domestic consumption story is more important than exports. So, yeah, I think the foreign institutional investors' interest should come back as we show the delivery of the earnings coming through with this recovery in domestic consumption.
Okay. The other aspect, Chetan, would be growth itself. because a lot of it being made that yes, the consumption-led growth will drive the near-term earnings, and maybe the GST is not just a one-off festive season move, but a slightly longer move. But on capex itself, even if the government capex, which had taken a bit of a step back in Q2, were to make a comeback, state finances are not necessarily the prettiest. Could state capex going off hurt overall capital expenditure for India?
I think that is a relatively smaller component of the overall capex story. So I don't think that will really be the bugbear for the overall growth story. In any case, I think the state governments are continuing to do reasonable amount of capex spending. I don't think the delta in that will be more than like 0.2, 0.3% of GDP that makes a difference to the overall macro outlook.
Chetan, an interesting point that you mentioned in just the previous answer is with regards to where the service sector is concerned and India being strong when it comes to exports. Now, the question I want to tie this up to is the impact of AI coming in as well, because everyone's talking about it, that India is still far behind. Now, what is the kind of opportunity you're seeing on that front? And two, where do you see India sitting with that direction when it comes to the service sector?
Yeah, so that is sort of you raised a very important question. That is one of the factors we discuss with investors right now, because when they are thinking about investing in India or having looked at the underperformance of India related to EM, this is one of the factors which a lot of investors attribute India's underperformance to. So the three reasons are: one is that, of course, the consumption story is not been picking up. That was the concern in the past. I do think that that is turning now. The second one is about trade deal and exports outlook, which also, as I mentioned, we're expecting a turnaround. The third thing is the point you raised, is that India is sort of like the anti-AI trade, because AI is going to take away India's services export story and have major ramifications on the labor market and job creation. We think it is a bit too early to start thinking about the impact of AI on India's services exports. Firstly, what I highlight to investors is that in terms of the addressable market for India's services exports, that if you can think about the DM economies, their services GDP is $40 trillion. Their services imports are at $4.8 trillion. So currently, that is the addressable market. But with AI itself and digitalization, you're going to see a significant increase in this addressable market itself. So that's the first counterpoint on negative impact of AI on India. Second is that even if you do see a substitution of, let's say, 5 employees with 1 employee, who is going to be more productive with him being or her being enabled by AI. What I gather by speaking to some of the companies is that even that one talented person is available in India. One is in terms of availability of skilled labor, and second is the cost of that employee is going to be cheaper than DMs. So we think that the dollar revenue impact of AI, whenever it actually does begin to happen, will still not be that significant. And India's dollar revenues, overall services dollar revenues, should still continue to grow. And I think one point is underestimated as far as the benefits of services exports is concerned, is that people always just think about the impact of that on the jobs that services exports create. Now, that's true that it does create significant amount of jobs, but if you take the existing stock of people employed in the services exports category, it's a pretty small number, under 3 million people. And so what is important from services exports perspective is that the dollar revenue boosts a country's saving, and that saving is used for investment, and that's how services exports are important for India's growth, not from the direct job creation perspective. If you just take the example of all of the East Asian countries like Japan, Korea, China now, the way they have grown fast is by increasing their exports. That exports revenue has boosted their saving, and then they use that saving to boost infrastructure investments and other investments. So that virtuous cycle will still be intact as long as the dollar revenue in India is going to be okay, and which we think will be.
Even if the number of jobs were to go down a bit, but the overall export number. Okay, Chetan, a couple of minutes. We're out of time here, but just one quick thing that you would want to see happen in India from a policy perspective.
So we think the government is doing all the right thing. I think the complex thing, which is still difficult for the central government to do, is to just improve that ease of business for the corporations broadly, domestic as well as foreign, at the state level. Because we have a lot of great policies that have been announced. But when you think about the actual execution for an entrepreneur at the ground level, that is the one which is, I think, holding back that aggressive push to manufacturing in reality. And the central government is aware about that, and that's why if you see a lot of the comments that you see from the ministers at the central level is about encouraging states to implement more reforms and get ahead with it. But it's in our federal structure, it's tougher one. But that's the one thing which, if the central government can figure out a way to incentivize the states to move on and participate on this structural reform, that's the one which would be really important.
Okay, so one of the interesting things, as Chetan mentioned, that we should be watching out for. But thank you so much for joining us on NDTV Profit.